Okay, so I hope everyone can hear me, and apologies to everyone for starting late. We had a few technical issues, but good day to everyone. I'm Stefan Pagacek. I am the Co-Chief Learning Officer for the HBS Alumni Angels Association and for our virtual learning series. We're delighted to have you here today for what we think is going to be a very compelling webinar on disruptive funding models. We're going to look a little bit at the history and then take a look at some important legislation that will definitely impact angel investors both in this group and worldwide. Our presenter today is Jesse Williamson. He's from 9.8 and he is Managing Director of Investments. And we got our PowerPoint all set to go. We've got some very interesting information for you and a little bit of a brain teaser that Jesse's going to introduce right from the top. And I failed this brain teaser, so I hope that somebody watching today is going to get it, because I've got a bet with Jesse, and I'm afraid I'm going to lose it. So without further ado, Jesse, the floor is yours.
All right. Thank you, Stefan. So good afternoon to everyone, and good morning to those of you on the West Coast. And yeah, I'm looking forward to that dinner, Stefan. So let's see what takes place here. So as Stefan mentioned, my name is Jesse Williamson. I am Managing Director at Wemutiply. Wemutiply is launching an equity crowdfunding platform with a goal of improving outcomes and prolonging lives by connecting transformational health tech companies with what we would hope to consider intelligent capital partners that are ready to drive rapid growth and adoption of those technologies. Wemutiply is a subsidiary of the 9.8 Group, which is a holding company that also owns multiple marketing, healthcare, technology, and advisory businesses. So today we're going to discuss disruptive funding models for early-stage businesses, and we're going to put a focus on recent changes and developments. So as a bit of context for our discussion, B.F. Skinner was a pioneer in psychology, and he was focused on behavioral theory, which indicates that individuals learn on the basis of responses to environmental stimuli. That individual decisions are actually the result of environmental reinforcement. And Skinner wrote a novel called Walden 2, in which he envisioned a utopian society where the will and the desire of the people, of individuals, was directly reflected in the management of that society. He didn't believe in democracy per se, but he did believe in both the virtues of democracy, for example, the will of the people as a guiding principle, as well as the reinforcing power of large groups of people to drive decisions that would otherwise not be made. So with that as a bit of background, here are a few topics we'll be looking to cover today. First, we'll be discussing some of the history of early-stage funding throughout the 20th century and the past decade. Of course, you all played a part in that. We'll also look at the rise and evolution of the crowdfunding model. We'll explore some of the regulatory changes, especially the recent regulatory changes that are influencing the market. We'll look at some of the implications of those regulations and market forces, et cetera. And we'll also try to provide some thoughts about what may be yet to come. And we'll look forward to your feedback as well. So here's that quiz. Since we haven't covered any material whatsoever, we'll look to test your knowledge up front. And so the idea is, can you identify America's first crowdfunding project on the basis of this slide? And the first correct answer submitted to Stefan will receive a box of chocolate chip cookies, parcel post courtesy of Wemutiply. So I'll give you all a few seconds to think, and not too long, because we're going to have to move quickly on this presentation, but at least enough time to get a response in if you have one. Well, I hope my team and I are going to be eating chocolate chip cookies for lunch, but Stefan, you can let me know if that's correct or not.
I'll do that.
So it was the Statue of Liberty, or at least the pedestal that the Statue of Liberty sits on. Joseph Pulitzer launched the U.S.'s first successful crowdfunding campaign, at least that we know of, to fund the pedestal after New York was in danger of losing the monument to another city that was actually willing to fund it. So it's a pretty crazy situation. And no, Mr. Pulitzer did not receive a prize for doing it either. But it's a nice way to sort of enter into the discussion. So let's do just that. So we would say Lady Liberty's pedestal might not have been the funding of an early stage business, but it was certainly a pretty significant construction project. And many changes have taken place since that time. So before we actually get into the specifics, I just want to quickly mention a few themes that we believe recur throughout the history of early stage investment. First, generally speaking, as we all know, markets desire to be efficient. Given time, they're always going to seek to optimize efficiency in the face of whatever regulatory or execution-related constraints exist. Second, subsequent to disruption, either through the introduction or removal of regulation, introduction or removal of new technologies, new models, etc., capital markets are typically going to experience a period of chaotic activity that will then be followed by a realignment and development of a new order that's governed by that desire for efficiency. And third, investors, generally speaking, are always going to seek a high return, which typically is going to equate to a high risk. But they also seek order and focus themselves as a function of their desire to manage that risk. And this desire is what drives realignment and the order in the market that we're talking about. So to get into the chronology, prior to 1933, the capital markets were basically governed by the law of the jungle. Early stage businesses were typically funded by a money order, and those money orders were typically provided by large wealthy families or less wealthy families, or basically anybody that could provide a money order. And of course, we all know how the Roaring '20s ended. Not so well for quite a few investors, frankly. In 1933 and 1934, we saw Securities Acts, which changed all this, providing rules and regulations for the registration and sale of securities, and severely restricting the ability of non-accredited investors, those without significant income or net worth, to participate in private capital markets, and completely banning the marketing of non-registered securities to the general public. So in 1934, we find a situation where access to financing and the ability to invest is severely restricted for the majority of U.S. individuals. 1946, we saw an interesting development. The American Research and Development Corporation was founded by George Darriot, former dean of Harvard Business School, of course, and the world's first venture capital and private equity firm. It's credited with the first VC success story. You may have heard of the funding of Digital Equipment Corporation. In 1957, ARDC put in $2 million of debt capital, $70,000 of equity, and ultimately this company did an IPO in 1966 with ARDC's equity stake valued at $38.5 million. So not such a bad deal for the industry. And so we're seeing here the initial efforts to pool investor capital and invest directly in early stage businesses. We might call it an early step towards at least a Rome-style democracy in finance with a limited set of participants. Fast forward to the 70s, we see the rise of Silicon Valley, due primarily to the emergence of large technology companies, as well as, some people are or aren't aware, significant government funding and incentive programs to back that. So we see Darriot's model being utilized in order to create an engine for growth and technological innovation. We're still seeing the results of that today. In 1976, Grameen Bank was funded as a research project by a gentleman named Dr. Muhammad Yunus in Bangladesh. And his goal was to design a system that would provide credit for the rural poor. And Grameen was actually authorized in 1983 as an independent bank, and this bank pioneered the provision of microfinance. Dr. Yunus later won the Nobel Prize for the work that he did here, and in a way, this continued the process of democratizing access to finance. In the 1980s, we begin to see institutional investment firms shift focus away from early stage deals, primarily due to declining returns. Although this was a trend that was soon to reverse in the 1990s, as the internet became a widely used tool and the dot-com VC boom started to take hold. 1992, by the way, a gentleman named Arthur Fox launched Royalty Capital Funds 1 and 2. These are pretty interesting, at least to me. These provide investors with a channel to invest in securitized royalty payments that were derived from revenues produced by the catalogs of David Bowie and the Beatles. So this is sort of a unique investment approach linked to a highly intangible asset, given that the only security you really have here is the future receipt of payments. But this is an approach that's actually gaining some traction today with early stage investors that are looking to leverage those types of assets and see a cash return. In 1996, a company called Credit Source USA was founded. This company was later rebranded as LendingTree, and they allowed lenders to compete for the business of individual borrowers. And initially, this was entirely focused on mortgage lending, a tangible asset-backed investment with a steady stream of cash income. But now LendingTree is diversified, and the industry is diversified to offer many types of funding, including business and personal loans, with their associated higher risk profile and lack of tangible asset backing. And then in 1997, and no, I don't know how big that picture is on your screens, but if it's big enough, I just want to disabuse you of the notion that might be Snape from Harry Potter. The U.S., it's actually the British rock band Marillion, and they funded their U.S. tour through their U.S. fan base and raised $60,000 online in what was the first ever online donation crowdfunding project. Again, the internet allowing the masses to play at the game of funding. Marillion was not the cause of the dot-com crash. At least I don't believe they were. I get the sense I was driven by larger, more macroeconomic factors, and I'm sure that Marillion's music did have some value, at least $60,000 worth. And by the way, second box of cookies to anyone here that can document current ownership of a Marillion album. We have lots of cookies in the office. But in any case, the crash did occur, destroying a good deal of investor value, but not in any way slowing the growth of the internet itself. And in 2001, we saw the music industry, perhaps as a result of both the power of the internet and the music industry's former stranglehold on artist funding and distribution, continued to lead the way on crowdfunding with the launch of ArtistShare, which was the first online donation crowdfunding platform. Continuing this trend, in 2005, Kiva launched. Kiva was a platform that built on Dr. Yunus's earlier work and was the first online peer-to-peer micro-lending platform. It allowed individuals to lend directly to underprivileged, undercapitalized individuals that were seeking to launch or grow a business. And so we see that continued trend of the internet powering a democratization of finance. In 2008, the financial crisis hit, and this caused, obviously, a major disruption to the traditional industry model. We saw banks and other large institutional players pulling back from funding early-stage businesses. And the creation, or I would say actually, the increase in what already was a significant funding gap for those higher-risk early-stage ventures. And it also created a class of entrepreneurs that were essentially treasure hunting for sources of capital. So simultaneous to that, we saw the launch in 2008 and 2009 of rewards crowdfunding platforms, Kickstarter and Indiegogo, which I'm sure everyone's familiar with at this point. And these provide a platform for individuals to fund early-stage concepts. At the same time, VCs, as well as incubation and acceleration groups like Y Combinator, for example, look to take advantage of this funding gap by ramping up activity in the segment. Following on to that, in 2010, AngelList used the internet to turn the industry on its head. And what was unique about AngelList is that it allowed individual angel investors to form communities, to engage with early-stage companies, to perform diligence, and either independently fund or pool capital in support of early-stage deals. So at this point, you see the full democratization of the investment process, at least for the accredited investors. And in line with this and other developments, angel networks that were empowered by the internet and ability to share information started to expand their reach further. As you saw VCs pull back and look for less risky, more upstream investments, where their capital strength and also their power to signal the market was a bit more advantageous. So this activity, the success of donation, debt, and reward-based crowdfunding campaigns and initiatives, as well as the continued lack of access to early stage capital, led to pressure to change the rules of the game. And so in 2012, we saw the passing of the Jobs Act, which set the scene for 2013's implementation of Title II and Title IV. And these two items really significantly loosened the restrictions on general solicitations and advertising or marketing of securities, at least where the purchaser would be an accredited investor. Title IV created a model which is popularly known as Regulation 8+, which allows both accredited and non-accredited investors to participate in what are often termed mini IPOs. And this development represented the first expansion of equity investment rights to the non-accredited investor base. In 2015, Title III rules were issued, and what we're looking forward to now is the May 2016 implementation of Title III of the Jobs Act, which is going to provide a significant expansion of equity crowdfunding for those non-accredited. So throughout this evolution, we're seeing three broad trends. One is a movement from investment in more highly secured to less secured, from more tangible to less tangible, and from lower risk to higher risk transactions as the markets have evolved following the 1933 and 1934 regulations and begun to democratize and enter what is a new period of significant change that we believe is going to be driven by the Jobs Act. So I hope you've all enjoyed your whirlwind tour of a few highlights from the past century. Don't worry if you weren't taking notes. I believe you're going to have access to copies of this webcast, and we're also going to be posting on our website a bit of a brief from you guys that's going to contain a good deal of this data as well as some additional notes. So let's take a look at a much cleaner slide. So how are traditional funding methods structured, right? Essentially, you have a group of investors who put together a pool of capital, and they use that capital to fund specific deals. Many variations on that theme, of course, but this is the basic structure. And of course, over the past few years, we've seen a good deal of pressure on this traditional model, which of course is still quite prevalent in the market. And what are these pressures? So let's start with the internet as a foundation for everything that follows. The internet is obviously a place where online communities can form. It's also a platform of communication of information to nearly every individual that has either an idea or a dollar to invest. Now, to add to that base, the advent of secure online payment processing, PayPal, Stripe, etc. These are creating a situation where people are comfortable providing a credit or a debit card and knowing that their cash and their credit are safe, for the most part anyway. In addition, we have today's social media-driven culture, which is allowing for the distribution of ideas, campaigns, investment opportunities to a much wider audience than has ever been possible. All apologies to Joseph Pulitzer and the Globe, as well as the potential for viral effects beyond initial distribution. And also, today's culture is a product of the fallout from the dot-com boom and the millennial-driven maker movement. So there are thousands, if not millions, of dedicated internet-savvy entrepreneurs that are looking to fund new and innovative ideas. You add to the mix the capital scarcity that resulted from the financial crisis, which caused huge disruption in access to the traditional model, and the combined effects are extremely significant. Just how significant? Significant enough to drive the ascent of the modern crowdfunding model. where many smaller investors leverage an online platform in order to gain direct access to crowdfunding campaigns and companies, individuals, and ideas all can compete to attract that funding. So again, we're looking at a movement from a market that's dominated by larger investors to one that is more accessible to a community of smaller investors. One that's moving from a highly sophisticated, in theory at least, investor base to a less sophisticated investor base. And generally speaking, we're looking at a significant expansion of the investor pool. In terms of numbers, the volume of crowdfunding transactions has grown significantly from about $2.7 billion in 2012 to $35 billion last year, and it's projected to grow to around $90 billion by 2020. Now, to be clear, this is a very difficult market to accurately gauge at this point, and there are a variety of market estimates, but we've used what we believe is the most reliable market data, which is compiled by a group called Mass Solutions, on the basis of what we think are some pretty comprehensive industry surveys. So now that we've looked at the scale of the market itself, let's maybe talk about some of the specific segments within the market. What are the various components? Well, the first component we want to look at, and if we think back to that first U.S. crowdfunding campaign, it's pretty easy to identify an initial entry point, which is donation-based crowdfunding, which we would consider to be the leading edge model. Projects in this space are highly tangible and extremely low risk, primarily because of the return. At best, you'll see something good happen, and you'll receive a thank you. The downside risk is minimal. You'll still get your tax exemption if you're given to a charity, and the expectation of any other tangible return beyond whatever good you've done is minimal. There is no monetary return. There's no dollar and cents component to this. That doesn't mean there aren't ever issues. We've all likely heard about what took place recently with the Wounded Warriors Project, fraud if you haven't. But these issues aren't ones that affect the investors directly. I would assume that the group is probably familiar with some of the major players in this field, and the volumes that are being done in the segment are quite significant. And so just to turn to some other segments, we can talk about reward-based crowdfunding. So I guess starting with that unbelievable UK bank, continuing on through ArtistShare and today's heavyweights Kickstarter, Indiegogo, reward-based crowdfunding was the next significant entrance of the space. In part, this was driven by the impact of the 2008 financial crisis and subsequent capital scarcity, but also by removing any middlemen, these platforms provided a means for direct funding of projects by a pool of backers that was limited only by a project's ability to generate online buzz. Again, these are projects that produce highly tangible results, and the risk associated is primarily the potential of a failure for the project to deliver on your handbag or your T-shirt, your tech gadget, or tickets to that British rock concert. Again, there's no monetary return. The only potential downside is a failure to deliver that's associated with the reward at hand. As far as an example of the model at work, we probably all heard about the Pebble. Their developers wanted to fund through more traditional methods, and only went the crowdfunding route when that failed. Even a few of us are actually wearing one. Pebble's had a pretty tough time competing, following on to their initial success. They certainly moved the needle, and were a big impetus towards wearables as a segment. Debt-based crowdfunding is a bit further out along the continuum. It had its roots in online competitive lending portals, such as LendingTree, but really began to emerge with Kiva's peer-to-peer model, which allowed individuals to participate on the investor side as well. Over time, debt-based crowdfunding has grown its reach far beyond those initial real estate-backed transactions to include the funding of a very diverse set of products, personal loans to consolidate individual credit debt, the ability for individual investors to provide debt funding for individual real estate transactions, This, by the way, was a market that was primarily driven by the recent regulatory changes, which has allowed these deals to be marketed online to accredited investors. Again, the key here is that while we continue to move out along the risk continuum, debt-based crowdfunding still involves a tangible asset underlying a return, typically hard cash, paid out on a predetermined schedule. And as you would expect, most interest is focused on transactions that are backed by hard assets, although as time passes and the market becomes more comfortable with increased risk profiles, there continues to be increased interest in less tangibly secured transactions. We've already discussed Kiva briefly, but they're a strong example of the model. It's worth noting also that Kiva's strong initial growth was driven in large part by the low dollar value required to participate, as well as the extremely tangible impact of participation. Just a few dollars could change someone's life radically. You'll see that cash return in the relative near term. So what do we think is the most exciting segment of crowdfunding? Well, we saved it for last. It's equity crowdfunding, which allows for direct participation in the ownership of a business. With the internet and specialized platforms providing a basis for the dissemination of equity deals. To date, this market has primarily been driven by accredited investors that are utilizing Title II and the old Regulation D framework, but the advent of Title IV or Regulation A+ means that new opportunities already exist for non-accredited investors with certain limits. And this May's implementation of Title III means there are going to be additional opportunities for that vast non-accredited majority to invest and receive in return a handshake. Not exactly true. You'll get a PPM or an offering document. You might get a stack of additional paperwork. If you're lucky, you'll see a stock certificate. But the bottom line is there's no tangible product. There's no amortization schedule. You're not even necessarily going to get a thank you. These are high-risk, intangible investments, particularly when you're looking at early-stage businesses. I thought an interesting case study might be Seed Invest. Seed Invest is a platform that would otherwise be a competitor to Wemutiply, except for the fact that they studiously avoid most healthcare technology transactions, which is a segment that we are focused on. They actually funded their own Series A on their platform, utilizing a combination of early mover VC funds to fill a sizable chunk of the round, and then a group of over 40 angel investors to complete the round. So what does the equity crowdfunding market look like? Well, historically, it's represented a pretty small slice of the larger crowdfunding space, but it is projected to grow faster than any other segment, and by 2020, it's projected to comprise nearly half of total crowdfunding deal volume. Most of today's deals are related to tangible products or services that can be in the market quickly and where there's a solid understanding of market need. Real estate, technology products and services, et cetera, sort of led the way. Again, we're seeing that preference for the tangible providing the leading edge of the field. So what are investors doing in the market? Well, as in any other market, investors typically are driven, at least to some extent, by familiarity and knowledge. They like to invest where they understand the segment and where they have a degree of understanding with regard to the asset class. Sector focus also allows for targeted and efficient marketing of investment opportunities, which is obviously becoming a factor with these new regulations and access points. So we're launching Wemutiply to address what we feel is both a pain point as well as an opportunity within the healthcare segment specifically. As I mentioned, many platforms like Seed Invest specifically avoid healthcare because of the domain-specific expertise that's required to properly address the segment. Others do specialize in healthcare deals, which makes sense given the emphasis our society is placing presently on health and wellness, but none directly focus on healthcare technologies, which, generally speaking, address a very specific and tangible market need, provide a recognizable product, or a service that can be readily understood, and which can typically be in the market in rapid fashion. So, while biotech, which you see on the left side of this spectrum, typically has a 5 to 10 year build to market, and there are significant difficulties around a potential exit. Health tech is typically either in market or market ready and provides far greater exit visibility. So our belief is that there is both a significant volume of high quality health tech deals that could make good use of equity capital, as well as significant pent up demand on the part of the market on behalf of both institutional as well as accredited angel and non-accredited investors that are ready to support those deals because they understand them. And just a brief note on one company that's very interesting, maybe a little ahead of its time, on the opposite end of the spectrum as us. Pollywog has a very interesting investment thesis. They believe that people are going to invest in segments that they understand and they're concerned about. So they'll organize their deals by disease state. You can invest in their cancer portfolio. You can invest in their diabetes portfolio. But they've had trouble gaining traction primarily because of the issues around time to market and ability to exit from biotech. So how can you fund equity via the crowd today? There are a variety of ways. Today, investors can fund Reg D deals, either through the more traditional 506B model. They can do that online through the crowd as well, or through Title II of the Jobs Act. And both accredited and non-accredited investors can fund Regulation A+ deals through Title IV of the Jobs Act. And of course, IPOs for the lucky few are always a possibility. How's that going to change going forward? The big change that's coming is the implementation of Title III of the Jobs Act, which is going to open the equity market significantly further to non-accredited investors and grow the pool of investment dollars available, albeit with some significant limits. So what are those limits? For one, businesses are only going to be able to go to Title III or what's known as the Regulation CF pool for $1 million every 12 months. Non-accredited investors are only going to be able to fund up to 5% of their net worth or income. They're earning below $100,000. If they're earning above $100,000, they'll be able to fund up to 10% with a total ceiling of $100,000. Resales within the first year will be extremely tightly limited. Only private U.S. businesses are eligible. Deals can be marketed over the internet, but all solicitation and disclosure has to take place on the funding portal or the crowdfunding platform. Any other publicity, social media or otherwise, is prohibited. And there are annual SEC reporting requirements that are associated with Title III. There are also some pretty significant risks, but some mitigants as well. For one, fraud is always a risk in any funding transaction. But of course, you can mitigate that through care and picking the right platform to invest through, understanding their process and the way that they process and work through their deals, as well as the people that you're investing in, and also keying in on the due diligence process. As with anything, investors should invest only what they can afford to lose. For market entrants, probably the best way to mitigate the risk of an evolving landscape is to do one of three things. Either take a wait-and-see approach as the field begins to settle, then move where you're actually confident. Two, hire a good attorney and get ready to file a lawsuit. Or three, hold your breath and jump in. But we also see some significant benefits. For one, crowdfunding platforms are going to make it significantly easier to set up and manage a campaign or a funding process. Two, launching a successful crowdfunding campaign not only proves interest in a product or service, but also shows people are willing to spend money on it. In addition, it can drive affinity support, pre-orders, and it can solicit investors all at the same time. So you're capturing different types of support simultaneously. It allows entrepreneurs to test the water without a heavy investment to validate a sustainable market. You can build their feedback. Crowdfunding is also marketing, and it's a great way to spread brand awareness and attract new customers. And the cost of reaching an audience to raise capital are significantly less than an IPO or other traditional methods, both in terms of time and money. We think it's an exciting future. We've got barriers breaking down and lines being blurred across the early stage investment ecosystem. We have equity platforms launching funds. For example, Seed Invest and our crowd have recently launched directed co-investment funds that invest where they close deals on their platform. We have groups such as Healthios Exchange that offer advisory services, a comprehensive suite to complement the crowdfunding capabilities that they have. And we see VCs beginning to explore integrating equity crowdfunding into their investment processes in order to leverage the marketing and strategic benefits that come along with crowdfunding. We've got access growing for all parties. It's a huge market. And we think the winners are going to be entrepreneurs that have more sources and channels for finding capital, the value-add investors with an emphasis on the value-add that are using the crowd to support targeted deals. So these are the VCs and the angels that can actually lead the crowd. And it's going to be the platforms that can leverage data and information to drive efficiency and capture users, meaning both investors and entrepreneurs. And so that's a good lead-in to a quick quote that I think shed some light on how angels and VCs are responding. Fred Wilson at Union Square is speaking to an industry where around $30 billion is coming into venture capital firms each year from banks and large institutional investors. He thinks only $15 billion can actually be intelligently deployed. Typically, these groups have invested around 4% of their available capital via VCs each year over the past 2 decades. In spite of the fact that the VC market has underperformed as compared to the stock market. According to Fred, angel investors are bringing an additional $1 to $2 billion into the same market. So, talking to Fred, his take is that there are a few options for these underperforming VCs going forward. They can either stop being followers and instead become innovators and find new niches. That's only going to apply to a few of those players. They can either do smaller deals that actually fill the funding gap we talked about previously. They can follow individuals like yourselves, take a more angel investor style approach that focuses on the management of their own capital. They can partner with crowdfunding platforms themselves, which we're starting to see to some extent, or he says they can just retire. We think that's pretty unlikely. So what's happening in the market? If we take a look at the different sectors and what they funded over the past few years, it's clear crowdfunding is on a steep growth curve relative to VC and angel funding. It's projected to reach about $36 billion in 2020, and at that point it would surpass venture capital as the leading source of early stage funding. But it's not a standalone source. It's inclusive of both individual and institutional investors. It is important to remember that, to Fred's point, crowdfunding platforms can scale in a way that VCs simply can't. They can appeal to a much broader audience with a smaller bite size, and importantly, they can rapidly test and evaluate a larger volume of deals in a larger laboratory. And this, in theory, would allow them to intelligently deploy larger volumes of capital, which is what the market has been and will be seeking to put into play, especially as we see the base of the market scaling. So what happens when this new class of investors, 250 million Americans that are poised under Title III and Title IV of the Jobs Act to invest for the first time? The answer is a lot of growth and a lot of impact. And it's an interesting future. What does that future hold? For one, there will be issues. It's going to be ugly. There's going to be chaos. There are going to be bad actors, and it's going to be extremely messy, as with any other democratic process. But we feel these issues will be resolved, and it's highly likely they'll be resolved more favorably than in the Roaring '20s. As comfort grows, I would predict that $1 million cap is going to be modified, and investors will branch out into more intangible, higher risk categories like royalty crowdfunding and biotech. We're going to see collaborations with traditional investment vehicles are going to become more commonplace, and new players are going to start to evolve their models. For example, SoFi, a former student loan and mortgage lender that is now a peer-to-peer lender, is working to put together a co-investment hedge fund that's going to take equity in peer-to-peer debt transactions. So they're not just going to arrange the transactions, they're going to co-invest alongside those transactions. And I think, generally speaking, we'll see the continued evolution of private capital markets toward a more democratic and ultimately efficient state. So for us, this is a market we are extremely excited to be a part of. So that's the end of my presentation, and hopefully I haven't gone too far over the time. And Stefan, if you'd like, hopefully we can field a few questions.
Absolutely, Jesse, and thanks so much for an incredibly informative presentation. And at this point, we're happy to take questions from the audience. I'm going to kick it off with a couple of questions of my own. And the first goes to a potential case study, Jesse, and this is something that you and I have talked about, and that's Dean Kamen's Segway. When Dean first announced the Segway, you know, he had people like John Doerr saying, of Kleiner Perkins saying, you know, this is absolutely going to be a hit. You know, there's just no question that this is going to be a game changer. Well, what happened? It didn't go anywhere. It didn't achieve the kind of scalability that people felt. And my question to you is, had equity crowdfunding been available, do you think the Segway and projects like it, which never, you know, saw the light of day, which didn't get traction even though they had strong initial backing, do you think equity crowdfunding could have made a difference in this case?
Yeah, no, that's a really interesting question, Stefan, and I would say a few things. One, if equity crowdfunding was around and a viable path to financing at the time that the early rounds for Segway were being put together, I think you would have seen, Segway still would have been funded. What you probably would have seen is a smaller institutional portion of that round. And I think you would have gotten enough of the public behind it just because of the novelty of the idea and the interest in personal transport to fund the round. Segway probably would have still run into the same issues. I think what would have been actually more interesting than an equity crowdfunding play for Segway would have been to launch Segway as a reward-based crowdfunding scheme, because that would have actually allowed the company to get a grasp of the true market demand and interest in Segway. In other words, they could have built production capacity and scaled to the level of demand rather than deploying capital in service of a business model that they thought was going to develop to one level and which didn't. The other thing that I would mention is one of the byproducts that we've seen, you know, alongside what happened with Segway is the rise and subsequent potential crash and burn, at least for the time being, of these smaller personal hoverboard devices. And I would speculate that they also are very well suited for that reward-based crowdfunding model. And the reason being that as it's a great space to sort of work out in the laboratory of the public sphere some of the issues that you're seeing right now associated with those. So, you know, what are the issues? One, they've exploded and caused all sorts of damage, which again is a process. And again, you know, the reward-based crowdfunding model is a great place for that learning curve to take place. But I think once you get to the point where you have that initial state of learning and you have a viable product in place, intellectual property concerns are resolved, which there's a good deal of intellectual property concern around hoverboards specifically, and you figure out who actually owns the IP. This is something that would be really interesting to fund via equity crowdfunding once you've identified that initial market desire to actually get behind a specific product.
Okay, great. Let's talk a little bit about, now you spoke of, you know, sophisticated investors and obviously people coming into equity crowdfunding not having the portfolio or the experience in investing as people on this webinar, people like Band of Angels, Launchpad here in Boston, New York Angels in New York. Talk to us a little bit about how this will impact the development of the term sheet, and specifically clauses such as ratchet clauses, participating preferred. For an unsophisticated investor and equity crowdfunding platforms, how much of an education is going to go into these platforms such that they understand the mechanics of the term sheet and can intelligently invest next to sophisticated investors?
Okay. Well, that question is packed pretty tightly, so I'll try to unpack it at least to some extent. And the way I'll do it is I'll sort of back up a step. One of the things that we've seen has been sort of a key element of successfully funded equity crowdfunding deals is there's a heavy institutional component that is investing up front. Generally speaking, as a rule of thumb, deals in the market typically are not successful in closing their round of financing unless they launch, and within, say, the first 24 to 48 hours, there is maybe a 20 to 30% commitment to the total round of capital. And this means a few things. For one, it means that you have institutional players that are already behind the deal. It means that, generally speaking, the structure of that deal has already been defined. Whatever nuts and bolts may underlie the high-level offering of a volume of capital for a percentage of equity. This means that for the non-accredited that would participate in such a deal, or for the, let's say, less savvy accredited that would fill out the remaining 70 to 80% of the round, this is both an opportunity to follow in the footsteps of those that are, in theory, more sophisticated, that are the institutional players that are jumping onto this deal. But it's also an opportunity to form an understanding and for them to educate themselves as to, in theory, more sophisticated, larger and more institutional players are going to require. So every deal is different. I don't think that, at least immediately, you're going to see significant structural changes to the way that these deals are done and the nature of the term sheets that are issued. But I would say that it provides a significant opportunity for a much broader investor base to become much more educated about the types of terms that you typically see in larger institutional plays.
Great. Let's go to sector specialization a little bit. Let's talk a little bit about that in terms of some sectors that may have trouble getting angel or venture capital financing. Does the equity crowdfunding model enable kind of the democratization of sectors such that, say, arts and media, okay, or maybe, obscure consumer products that wouldn't necessarily be looked at by either, sophisticated groups of angels or early stage venture capital firms? Are they going to benefit? Are the equity crowdfunding platforms going to be able to stay with them and build some traction such that other investors, other more traditional investors, are going to come into this because these equity crowdfunding platforms have been able to establish some traction?
Yeah, and I think the answer is yes, yes, and yes to each of these. For one, I mentioned earlier, typically, most deals don't get funded unless you see pre-launch or extremely quickly subsequent to launch a significant portion of the round subscribed to. But that 30% doesn't necessarily need to come from the pockets of 2 or 3 sophisticated angels or VCs. If you can develop scale of interest through smaller funders, you're effectively defining a market. And with that market definition comes the ability to define let's say an ability for a company to actually successfully offer a product or service. And when we talk about niche sectors, for example, biotech and the development of what we would now call orphan drugs for specific characteristics or disease states. When we talk about artistic or creative products or niche consumer goods, there really is a leveling of the playing field that's provided by the ability of the internet to reach large numbers of individuals. Right now it's primarily focused on accredited investors, but as that changes and begins to open up to non-accredited, you're going to have a situation where there are going to be multiple untapped markets that are going to be identified by the individuals that have the ability to invest directly in those. Over time, as we see investors, both accredited and non-accredited, developing a higher degree of comfort with these less tangible investments, with higher risk investments that are going to take a greater time to market, I think you're going to see exactly what you talked about, as well as you're going to see success within some of the markets that are probably 2 or 3 years down the road, and I'd use biotech as a specific example of that.
Great. One last question, Jesse. Angel investors are known for giving advice, especially when the company that they're investing in is in a sector that they have a lot of familiarity with. They have a Rolodex of connections. There's a lot, that we can do to help these companies get through the painful stages. Can equity crowdfunding, can these new funding models and these platforms offer the same kind of sort of personalized service, if you will? I hate to use that term, but for lack of a better term, can they become involved in such a way that the entrepreneur benefits, or is this just a way for the entrepreneur to access capital quickly to speed to market and gain traction?
I would say it is absolutely the former. For one, when we look at some of the ways that angels invest right now, it's typically through the formation of communities, like this group specifically. But one of the largest communities that's out there, AngelList, is in fact one of the groups that actually drove the rise of equity crowdfunding. And AngelList is predominantly characterized by the fact that it actually is the formation of a community. And these platforms, in fact, I think far from just becoming an ATM for early stage companies, if they're going to be successful, they're going to be platforms that help drive more effective, higher touch communication, both between individuals within the investor community, individual angels, but also the angels in the companies. When I speak to some of the folks that are in the field right now, and as we're having conversations with our partners, one of the things that people are really looking to do is to leverage those platforms to help facilitate that communication and then that interaction. The best PR, the best press that any platform can ever get is a successfully closed transaction. But even better than that is a successfully closed transaction that leads to a successful exit. And you're only going to see a successful exit when all of the potential positive factors are working hand in hand. And there's probably nothing that's going to be more influential on the success of a business than having investors that can take an active role in smoothing the way for and accelerating the growth of early stage business. So I would double down and say absolutely they can be helpful, and I think probably they're going to be one of the more significant factors ultimately in helping to develop these businesses over time.
Great. Jesse, thank you so very much. We're bumping up against the end of the hour, but thank you so very much for a tremendous presentation. This is great material, great information for us going forward, and we just want to thank you so much for taking time out of your day to share this with us. We'll be posting this presentation for those of you who are interested in the slides, and if you want to get in touch with Jesse directly, we'll also make his contact information directly if you have more specific questions later on. In terms of housekeeping, we will have an announcement shortly about next month's webinar, which right now is on hold. And other than that, we hope you all have a fantastic day, evening, morning, wherever you are in the world. Thank you again for attending, and we will see you hopefully next month. Thanks.
All right, thanks, Stefan.